Hello and welcome back to another video. Today we're going to be talking about rates. I'm not giving you guys a rate update. I'm giving you guys a breakdown of fixed adjustable rates and what that means for you and what that even is. So let's get right into it. To start off, I'm just going to go briefly over the kind of loans that are offered by lenders. And usually it's FHA, conventional, and VA, right? And within that, within the conventional, you have a 30-year and a 15-year. So with the VA loan, again, that's reserved for our service personnel with the military. And again, thank you. Big shout out, huge respect. Thank you for serving our country. I help a lot of military folks and love to help you guys. The least we could do. And rates on those are around 6 and, let me just look at note, 6.26 or so. So it's a great lower rate for those kind of loans. Again, take advantage of that if you are in that category. For the rest of us, and you have a FHA and conventional type of loan, which is, here's a big difference. FHA loan, it's government backed. It has lower set requirements, so your credit score can be lower to qualify, and you don't have to put as much down payment. So I think it's around 3.5%. So that being said, it's a very easy loan to get qualified for and get in, and it's lower rate. I mean, it's at 6.25 as well. So a lot of people jump for that. It's a lower rate, cool. However, the catch, right? There's always a catch. The catch is you have to get private mortgage insurance, PMI, on it, which is going to cost you another couple $100 every single month on your payment. And you can't get out of that. You can't get out of that unless you refinance into a conventional loan. And I did a video on this on PMI a few videos back, so take a look at that. I'll probably link it in the description or whatever to this next video. But that's the big difference between FHA and conventional. I don't want to talk too much about that. I want to talk about adjustable rates. So again, FHA versus conventional. Conventional is around 6.8 currently. So yeah, you have a 0.6% increase in rate. However, you don't have to get PMI if you put 20% down, or at one point you can get out of it as well. Again, last video on PMI on my YouTube. Let's talk about the 5/1 ARM, or ARM stands for adjustable rate mortgage. Let's talk about that for a second. Why would you do it? Why wouldn't you do it? Well, again, my 2 cents, don't do it. Just don't do it. It's not a good loan. It's a tricky loan. I mean, maybe for someone who wants to jump in at a lower rate and take advantage of that, sure. But right now, definitely not the time. Here's why. First off, let me tell you a little bit about ARMs, what they are, what they do. So an adjustable rate mortgage, the first 5 years, you're at a lower fixed rate. So say the current rate is 6%, you'd be at 4. That's not the case currently, but I'm just giving you a scenario so you can understand this. So the first 5 years, it's fixed at a lower rate than all the other mortgages that you can get. So it's enticing. However, after that, for the remainder 25 years, it can go up every single year. Can. Maybe it won't, but most likely it will. So therefore, you may start at a 4, but you'll be at 6% later on anyways, and higher. So while everyone else is fixed in that 6 for 30 years, as rates increase, you can jump to 8, 9, 10%, whatever the market does, okay? Again, these loans aren't really being offered for the most part or marketed because they're not currently profitable for lenders. They're high risk and such, and with the economy the way it is, you're not going to see a lot of those options out there. So mostly you'll see is regular traditional 30-year fixed, and who knows, maybe we'll even see 50 and 60-year fixed if our economy tanks. I don't know. That's just one of the predictions, right? But so that's how adjustable rate mortgages work. If you're still having a hard time understanding how they work, think about a credit card. In a sense of you have an intro period and then it jumps up, right? And it fluctuates as market rates fluctuate. So that's very much like with a house, except you wouldn't want to do that with a $500,000, $600,000 loan, would you? No. The reason people do these, you might ask, like, well, so why is it even on the table? Why do people even take advantage of these? Well, because it's meant for those who plan to stay in their homes for a short period of time, but have lower rate, lower payments, and then get out, sell it, and therefore be done with it, right? And then get a different kind of loan program for their next house. But here's the catch. Do you know if you're going to stay in that house for 5 years? You don't. A lot of us thought one thing, and then guess what happened? COVID broke out. Then we thought this would happen, and then look, we're in a war. I mean, like, it's ridiculous, right? You can't really plan for certain things to happen in your life that far ahead. So for most people, without a huge safety net and a huge savings, I would say don't do it. It's too high of a risk for normal people like you and I. Maybe you're a millionaire watching this and you can do it, but for the most part, people watching this video and such, this is not a good product for you. It's like the times when they had interest-only loans, and a lot of people lost their homes over that because they were paying their interest only, but totally forgot or totally spaced or weren't educated, and then the full balance was due, and they're like, what? Or then they owed this different amount. They're like, what do you mean I was paying only interest? Now I got to pay the principal? Anyways, guys, there's a lot of loan programs that sound enticing, but you got to read the fine print. Be careful. Talk to your agent. Talk to your lender. Make sure they're educating you and aren't just putting you into something that just sounds good. And just remember, if it sounds too good to be true, it probably is. So hopefully you learned something today. Hopefully this video taught you something today. Again, a lot of risk, but just wanted you to know the difference between an adjustable rate mortgage and a fixed rate mortgage. And just to kind of finish this video off, I want to talk to you guys about 15 and 30 year, because most of you guys will be getting one of those. If you have a solid income and solid savings, a 15 year is great. It'll push you to pay it off faster. However, you can do the exact same thing with a 30 year, and sure, the rate is higher by 0.5%. If you pay double your mortgage payment, you're already going to be paying it off in 15 years. So a lot of times security and safety is a lot more beneficial to you than a half a rate of interest rate. So hope that helps. Until next time, guys.